What's up, everybody? It's your boy here back again. Um, we're gonna kind of go ahead and get into this. So I'm making this video here. I'm gonna try to keep this as quickly, as I can, because I got a lot of stuff to do here. Not much time to do it, but I wanted to make this video because I think it's important for a lot of you guys who are, basically in this, which is pretty much everybody, because this is gonna be a very um important session to learn. Okay, so I'm gonna try to make this as quickly go by as I can. I'm not gonna go into super details. I'll give you the ability to do that on your own. But what we're gonna talk about here is gonna be something a little bit more different than what we normally do when it comes to just day trading videos. In fact, this isn't even gonna be a day trading video at all. This is gonna be a more along the lines for like long-term investing and things like that, just for you guys to have some more financial insight. From my opinion, again, this is just my opinions, no, advice on what to do and things like that. Just my, you know, 2 cents here, and this is all for entertainment and education purposes only. So, with that being said, if you're trying to look for like some type of, I don't know, trading video, skip this one, go do something else. This isn't the video for you. Unfortunately, look at something else on the, on the channel. This one is going to be more aligned for long-term investing. Okay. So without further ado, I'll kind of jump into this and kind of discuss, what we're going to be talking about here. So before we do this, guys, make sure that you can, like, comment, subscribe, all the above, help engage with the algorithm. I think it's important for a lot of people to kind of get this information. Um, and yeah, leave, whatever footprint you want on it. Give me your 2 cents. I want to hear from the rest of you guys as well too. Get your thoughts and everything like that. But it is August 17th, 2025. So this video here, right, is going to be talking about what could potentially be the next recession. Okay. Um, and I'm going to cover just aspects on that and that only. And for you guys that are watching this and like that, you're like subscribed, either like, to the alerts channel or anything like that. I'm going to be talking about some other stuff as well too, and regards to this, and we'll discuss that here a little bit later on uh, afterwards too. But for everybody else, this is just information for you to have. So let's kind of go ahead and get into it, and let's you know pull back the curtains. All right, so let's go ahead and get into it here. We'll go to the next slide. All right, so the objective of this whole entire video here is just, like I said, to inform you guys, help you become a little bit better prepared, and help you understand the bigger picture. Um, Again, too, on my perspectives on things, because, like I said, the market, changes all the time. I think we're about to anticipate that change coming here, and if not shortly, the next year or two or so. But just want you guys to be prepared and have as much information that you can to make an informed decision. So that's what this video is going to be about. Okay. And so this is important, guys. This video is for people who have a 401k or retirement, or if you plan on retiring in the next couple of years, if you're thinking about getting a 401k and things like that, or if you know someone who has 401k, guys, please share this with them. Um, you yourself, if you're about if it's about you, definitely watch this whole the way through. I want you guys to learn from my mistakes, or not just my mistakes, but just kind of learn something that I wish I would have known when it came to this stuff here. Okay, because your 401k and your retirement, that stuff is important, especially since this is the whole reason why you guys wake up in the morning and things like that, is to have that financial stability and things like that. I think is important not only to make the money, but be able to manage the money as well too. Okay, it goes hand in hand, because the quicker you make it, the quicker you can lose it. All right. So this is what this video is going to be about, is focusing on the 401k, because I do believe that that is going to be where pretty much we're going to see like the next recession kind of hit us and things like that, which is why this video is important. And you guys know me, I like to come with receipts and results and not just making this up out of the blue. And that's another reason why I'm making videos for this outside of my time. I could be doing other things. I have other things I do got to do, but you guys know when I'm making this video, I'm backing it up with documents, research of my own, and just things like that. So you can do the same thing as well. Okay. All right. So let's talk about why this is important, because obviously, it's your money, it's your time, and it's your life. This is what you have been working towards. So, again, not only is it important to make the money, but it's also important to keep the money, you know? And really, I mean, if this whole thing and economy that we live in is really, about capitalism, I mean, you might as well be able to play things to your advantage, okay? Um, and do what you can do to, you know, protect your assets. So that's why this video is important here for you to learn and understand because you need to know what's going on with your money, and that's what this is going to do. Okay, so to kind of start from the beginning, right? Let's talk about the references of where this kind of kicked off. So let's kind of kick it off from here. References, things I'm going to be referencing is your 401k, private equity firms, and basically overall market. All right. Um, a lot of this information, I'll kind of give you guys a backstory on it. It's just basically coming from, you know, finding out all that information. So let's kind of jump into where it all started. So basically, uh, there's a I guess influencer, is what you want to call them, is that I came across my little For You page when I was scrolling on TikTok, right? Her name is Tiffany Salancy. If you want, go follow her. This is kind of where things kind of kicked off for me. Um, where in March 18th, she had made a video saying that she had discovered, you know, possibly where the next big recession is going to come from. And you guys know me, financial person. I'm going to, entertain any, ideas or, you know, basically any claims of being able to know something that maybe not a lot of people have known. And, to her credit, when she first made this video in like March, I didn't really give it too much merit. I'm like, okay, that's a good idea. But I'm like, the things she was explaining, I was like, it makes perfect sense. It seems logical and things like that. But the odds of that happening, I'm like, oh, they're not going to let that do it. They're not going to really have that happen. So, okay, that was then. But basically, it kind of came about where she was discussing, Hooters going bankrupt, what and the reason why, and all these other companies too. Like, I mean, Red Lobster, if you think about it, I mean, Joanne Fabric, she was talking about because they're like a lot of these places. I'm like, I know I go to these places. I don't see how they, if I'm going to them, I'm pretty sure the average person is going to them, which means that they've been around for a while too, right? So they should be profitable, at least, especially in this kind of economy. They should be okay, right? And be protected. But um, if you guys are in the market too on a day-to-day basis, like I am doing when I'm trading and things like that, you're recognizing these patterns. You're seeing like companies announcing bankruptcies and blah blah blah. I'm thinking too like, oh, that's a normal part of the process. It's capitalism at work. Companies, survive and they thrive. Blah blah blah. Innovation, things change. So I'm taking what she was saying with a grain of salt. And then but as I'm in the market, I'm like, yeah, so and so got bankrupt. Okay, that's normal. But then, I'm starting to think like, okay, well, that is kind of weird. Like a lot of these places that been around for so long started to, go bankrupt. Why is that? And she started digging into it. Again, I'm not going to go into the statistics and the numbers that she found out, which was pretty, crazy. Um, but basically, she was saying they're going bankrupt because of private equity. And of course, the end game of that is that private equity is going to cause the next recession because of the fact that you can hide it much more easier um, than what happened in 2008 for those of you that were around during that time frame and us bailing out all these big banks because of risky bets and things like that they did. So she was kind of mentioning how the way they're doing it secretly is through what's called a collateralized loan obligation, CLO. Um, and it basically it's a back floating rate loan is what it is, but they package it into CLOs. So a back floating rate loan is basically like an adjustable rate loan, that private equity has made. So this video here, guys, is going to have a lot of financial references in it. I'll do my best to try to explain it to you guys. I don't think you need too much of accounting, background or knowledge. You'll get the gist of what I'm saying. Um, I would assume, as I'm kind of going through this and breaking it down, I'll put as much, analogies to it as I can. But yeah, that's apparently what's going to be causing the next recession. The thing is, the way that it's going to happen is going to be through our 401ks, um, for people who have them. And she started putting the pieces together. I'm like, dang, you know what? That makes absolute sense. And the reason why I'm making this video now is because before, when she had mentioned it, again, didn't pay any attention, because I'm like, they don't have the ability to do that. But ever since what's recently happened in the economic climate, bills passing and things like that, now they have the ability to basically make this thing works. And I encourage you guys to go watch her videos if you have time. Again, Tiffany Solancy, I'll try to put her information in the video and things like that. But she explains it very well, especially if you don't have any kind of financial knowledge or understanding. She breaks it down really, really good for anyone, I think, to understand it. And for those of you who do understand it, you're probably looking at like, whoa, okay. I already am not a big fan of 401ks and pensions, especially for people in retirement, but it's been pushed to the public so much that it there's no getting rid of it, kind of thing, especially after what happened. Again, this is not a history lesson on finances. I'm just letting you guys know of what to kind of expect and why this is the case, so that when it does happen, you're not surprised. You're like, dang, we went over that. So let's kind of get into that part, okay? But this is basically where it all started. Me seeing that video, her talking about the private equity about to bankrupt, 401ks and using that as a bailout. And of course, that's going to hurt you as a consumer and people who have ones and plan on retiring, which again is going to affect the market. So that's kind of basically where this all started, was me coming across that video. And what led me to making this video was not only the bill passing and things like that that's causing this to happen, but me getting information as well too, personally, about my old 401ks that I don't even use anymore and things like that. But we'll get into that in a second, on why that's important. All right, so now that you guys got the gist of what we're going to be talking about and how this stuff's going to process, let's kind of break this all down here, together and get an understanding of it. Okay. It's only like a few slides. It's not really that long. Oh, sorry. But basically, let's kind of get into the backstory of it. All right. What a CLO is, guys, a collateralized loan obligation, is basically like a CDO, which was a collateralized debt obligation, but like a different version. This is, instead of it being for homes, because remember back in the recession, 2008, the CDOs were built up of people who had homes with bad credit scores and things like that and couldn't afford the housing and all that good stuff. So kind of picture a CLO as that, but instead of it being for homes, it's going to be for small businesses. Homes are included in it as well. People who have bad scores and can't keep up with, payments and, you know, that as well, but also picture that, but with small businesses and other risky things all into one. That's what the CLO is. It's like CDO 2.0 or on steroids. Okay. But these new CLOs are not, like I said, they're not just mortgages. They're things like business loans, small business loan, merchant cash advance loans, all of the things that are basically a bunch of crap and bad debts that probably won't get paid.
Damn it. Sorry. This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. The modern ones are different. They're private, and they're made up of layers of tranches. The highest level AAA is getting paid first. The lowest rated B is getting paid last, taking on defaults first. Now, obviously, if you're buying Bs, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these Bs and double Bs went from a little risky to dog stuff. Where's the trash?
Behind you.
I'm talking rock bottom FICO scores. No income verification. Adjustable rates, dog stuff. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close, is an opportunity. Okay. Want me to really blow your mind? When the market deems a bond too risky to buy, what do you think we do with it? Take a guess.
I don't know, you tell me.
All right. You think we just warehouse it on the books? No. We just repackage it with a bunch of other stuff that didn't sell and put it into a CDO.
A CDO.
Yes, a CDO.
What is that?
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified. And then the whores at the rating agency give it a 92, 93% AAA rating. No questions asked.
Say that again.
A collateralized debt obligation. It's important to understand because it's what allowed a housing crisis to become a nationwide economic disaster. Here's world-famous chef Anthony Bourdain to explain.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael Burry shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin. So what am I going to do? Throw all this unsold fish, which is the triple B level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a seafood.
A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market. Institutions treat these CDOs like they're as solid as treasury bonds, and they're going to 0.
Okay, so now that you got an understanding of that, like what a CLO is, basically understand that right now at this moment, the CLOs, they have about $3.8 trillion of debt for private equity that the private equity basically has, right? 1.3 trillion of that, I believe she said, is in real estate, which was the same level that it was back in 2008 when the recession happened. So the rest of that stuff is through small businesses, different loans, and other bad debts there as well too. And it's at a $3.8 trillion deficit there. So it could be small businesses, local businesses, things too, like she said, daycares, restaurants, doctor offices, dentists, things like that. Little things that you probably use in your community, all up in that. Okay. And the problem with those CLOs and what is happening too, right? Remember, with them being adjustable rate loans, those things increase, and payments are due. Obviously, interest rates are higher than what they were when these loans were taking out, but that was kind of the risk that these guys took when they basically made these obligations, these loan obligations. So, with that being said, kind of anticipate that obviously interest rates have gone up, payments are being due, but think about the overall economic perspective of things and what's happening. It's obviously brewing to be very, very detrimental. So, the problem is, since it's getting hard for these loan obligations to be paid, what's happening with this debt? And it's good to understand the process of what they do and how this is going to affect, your pension and 401ks and things like that. All right. So to kind of get into it, basically understand that when it comes to these debts here, banks, well, these private equity firms pitch these things to the bank, like kind of like in the video, you diversify them enough, it looks like, oh, it's a diverse portfolio of different things. Well, I mean, technically it is, they're not lying, but it's crap. But it looks like it's good because it's diversified, and we all know diversification is supposed to be the safest thing to grow an account, right? So imagine a private equity firm is telling a bank this. A bank is saying, okay, well, perfect. We can give you can give this to people who have 401ks so they can help grow their 401ks. Little to the wiser, you guys don't know that, or even the 401k asset management as well too does understand that, hey, these CLOs that are in this, is basically junk. So that's where that kind of plays into account. And so now that you know a little bit of backstory about what the CLO is, let's kind of jump into like the why and how of this process and it taking place. So basically, this obviously this diagram is going to be a little bit complicated for those of you who don't understand. But in a sense, it's good to know how everyone gets paid And I'll kind of summarize that up in not only how they get paid, but also how the process is. Okay. So the way it works, once private equity has like all these debts here, usually what happens is they'll play hot potato with the debt, right? Basically, sell it to somewhere else where they're anticipating to get a return on that investment. Because essentially with debt, they're assuming that people are going to pay it back. Most people don't. Okay. So picture a bunch of that happening, and they're telling other places like, hey, I have this big old package of debt you can buy, and it's going to help increase your wealth because it's a diversified portfolio, basically, right? So what happens is, and I won't get into this too much detail, but it might be kind of critical to understand that when that happens between companies and basically organizations, they can make it look like the profits from that for, I think Tiffany was like, she was saying it was 10 years. Um, the projected, you know, the projected um, result of it for the next 10 years is what you could put on the books. So on the books, it looks like, oh yeah, you're going to have a growth for 10 years kind of thing, right? When that's not really the case because, it's crap. But that's how it plays out on the books. And so basically a lot of times what happens when it comes to these things, banks will shift them and sell them to other places, and they'll sell it to another place, and they basically, like I said, play hot potato with the debt. Now we're at the point to where it's gotten so big and not so great to buy these things. Nobody wants them, like, because they're not getting a return on their investment. It's actually costing them more money to try to maintain having these CLOs on their books than it is to actually have them on the books. So it's operating in a deficit. And usually what happens is every few years or so, a place will, buy it and sell it, but no one wants it. Even one of the little tricks that you would do is two companies who have the same portfolios that are a bunch of full of crap, they'll sell them to each other. And, at that point, it just looks in their books like they're making a lot of money or that it's doing well, but it's really not. And they can't even sell it to each other at this point, which is crazy. Normally you can flip it like every, I think, 3 to 4 years, they'll flip it. But for the last, what, couple years, they got like a 6 year plus backlog of these kind of, loans in their books. And because no one wants to buy them because they're pointless, right? And so obviously when that happens, you're not making any money. It looks really, really bad. Basically, it's like a house of cards eventually about to fall, you know, because everyone is thinking that, oh well, if no one's going to buy this debt, what's going to happen? Those bills are still coming, right? You still got to pay on that interest because the contracts say that you have to. So for that organization that holds those on their book, guess what? It looks bad, and that's how a lot of these companies, like she was saying, like Joanne Fabrics and stuff like that, was going bankrupt, even though they were profitable. It's because of the fact that private equity came in there, bought the company, stripped it of its assets, and said, use that to basically pay off, try to pay off those loans. And so they're at the point to where they can't really give it to anyone else anymore. And so here we are, and big places like Harvard and Yale and all these other private equity firms are kind of stuck. They're not making any money on the books. Okay. And so, with that being said, what are they going to do? They need to find a way to get some type of income, right? Somewhere or another. They got to have money to come in from somewhere to pay off these debts. And so here comes basically this bill to kind of mess that up. Now, all right, so let's look at it like this, right? You have private equity, which is making all these crazy bets and giving out all these crazy high interest things that people can't keep up with, and eventually it's basically defaulting and things like that. All this stuff on paper saying that it looks good, but it really doesn't. It's a bunch of crap. So you have private equity who's going to get paid because they're going to give that basically that portfolio to the bank, who's then going to turn around and give it to your 401k, your pension, saying that this is going to be a good investment for you to do with your money to have it grow over the next couple of years. So a good thing, like I said, to know is how everyone gets paid. Private equity, of course, is going to get paid because their fees are ridiculous. Then you have the banks who are going to get paid regardless of what your pension plan or your 401k is investing in. And of course, you have your investment managers who get paid fees, a percentage of your 401ks and things like that. So everyone has their hand in the pot basically to try to get you more money. That's essentially what it is. Because it's money, nothing's guaranteed. Obviously, they tell you to be an informed person, investor, and risk and all that little fine print about, you taking the risk of trying to grow your money. Anyways, that's what's happening in the background. Okay, private equities taking all their crap, making it look like it's beautiful, but it's not. Telling the banks to go ahead and tell your 401k investors and managers to go ahead and invest in that because it's going to make you more money when in reality it probably isn't, but they're going to get paid through the wazoo to get it done. Okay, so that's kind of how that works there. Now, let's kind of talk about the next part. Like, you know, we can go into, I won't go into it too much, but what their fees are. Higher fees and fees is basically what they're going to get. That's why they're pushing for this because not only can they not afford to pay off the debt that's there, but they also got to pay their management fees, which again is astronomical. Tiffany breaks it down as well too. So again, guys, go watch her video when you have a chance. But that's basically how that works out. So they're getting paid like basically double as private equity. They're getting their fees and they're getting the management, for actually recommending it to the bank and the pensions. You on the end of your 401k is supposed to be getting like growth in your 401k when in reality you're probably going to take the loss. Okay, especially after what's passed. But the reason why they don't want to do this publicly, of course, because imagine if, I mean, 2008 was not that long ago. If it came to find out that we, the taxpayers, had, because we basically, let's say we bailed out more companies who made more bad risk instead of them going under like they should in capitalism, they're using people's money to bail them out, their hard-earned retirement. If that was public, people would probably go crazy. Okay, so instead, it's better to put it have it being done behind closed doors. And the way to do that is through a 401k because guess what? People don't really look at their 401ks like that, do they? It's the last time you looked at yours. Exactly. So that's how they're going to basically play this game to get that money because again, with them having about close to $4 trillion of a deficit, not not only that, but they got to pay their management fees, which is again ridiculous. I think it's like 60% compared to like a normal just management of your 401k. It's ridiculous. So because of that, they got to find that money, and where they're going to find that money in your 401k. I think she was saying it's like either 12, I think 12 trillion. So it's more than enough in there to tap into people's 401k and use that to pay off the bad debts and the management fees. Okay. Banks are going to get their money because they're banks. They get their fees. Plus these private equities and these pensions, they get much more of commission and payoff of that selling bad debt and getting bad debt. That's just how the fee structure works. The more riskier the bet, the higher the payout is for them because it's not likely. I mean, you could have a great return, but it's not likely. So that's just kind of how that works. No, it might seem like I'm all over the place, but you'll get the gist if you kind of watch our video too. So no worries. But basically, just know that your 401k will cover all the fees and all the greed that they want to get this stuff taken care of. Before, they weren't allowed to do this. Okay. This was usually before that not something that can be done. How do we get to this point? Well, the one big beautiful bill that passed recently, I think in July. So kind of keep that timeline in perspective. It's March, April, May, June, July. So 4 months later, after she had done her digging, she's like, oh, okay, hey, look at that bill. In that bill, it says that they have the ability to access those funds. I mean, I'm not even going to talk about all the other stuff that's in there with them taking away Medicaid and all this other crap, but we're focusing on your 401ks. So they have the ability now to let private equity go in there and do that. And of course, they're going to disguise and hide it with technical jargon. They're going to tell you guys it's all great because they're using it for what? Safety, security, all this other mess they want to make up. But mainly, one of the biggest things that's in there is the fact that they can actually do that. And I'm like, okay, yeah. If you want to go read the bill, you can. It's really all it's online. It's not super long. I mean, if you're a reader, it's probably not super long to you, but you can still check it out. It breaks it down into sections. But basically, it's going to allow them to access the capital to not only pay off that debt with your money, but also pay their management fees and things like that, which again is astronomical. Imagine 60% of your retirement disappearing just in fees alone. Well, that's what they can do now. So crazy stuff like that. But this executive order is just basically what's going to allow them to get access to that $12 trillion. That's just what I really want to point in. Now, there are some, I think she was saying that there are like lawyers prepared to like, fight them having to, access to your 401ks to pay off these debts. Because again, most people aren't going to want that to, oops, sorry. Most people aren't going to want that to happen, right? Which is obvious. So imagine doing it right up under their nose. But the thing I think about with them saying that the lawyers are on standby to do that, I don't think that's going to be able to play out. And here's why. Because again, you investing and stuff like that comes with risk and obviously, and it's nothing's guaranteed, right? But also, the argument would be that the public wasn't informed and stuff like that, probably more than likely. But in fact, there is informed. They are being informed. And so again, I didn't think that, it's possible and things like that. And usually when, things pass and you can just kind of check this timeline, it's just ridiculous. I'm like, okay, well, the things she was saying and what we're talking about is probably actually going to be lining up and come to fruition. Now that the bill has passed, all of a sudden, uh, I'm getting random notifications and letters in the mail about my 401k and things like that. I still have one from like old jobs that I work. And in fact, I've gotten letters saying that I had 401ks at places that I worked at years and years, over decades ago. I didn't even realize I had money in these things, right? So I'm getting all these letters about 401ks, and I do have like one main one that, again, I'm not a big fan of 401ks, but I just happen to have one. In fact, I don't even plan on using that money. I'm probably, give it to my kids or something like that. But anyway, it's a substantial amount in there. So it's something worth doing something about. Okay. But anyways, so because that's happening, and I'm looking at her video, I'm like, okay, well, why would they be sending me stuff about 401k now? Why are you waiting like over a decade to send me information about 401ks and you're finding 401ks that I recently had? That's red flag number one. I mean, I'm not gonna expose who the 401k places are, but I know like, okay, well, if it's a 401k place, they probably do hold private equity in my portfolio. And you'll see that in your 401ks, guys. Like it'll show it's disguised. What you'll understand, like a lot of these financial institutions will disguise it under technical terms that they hope that you don't understand to basically do what they want, right? And so again, gotten one from one company. Again, I'm not going to expose the company, but I got one letter in the mail talking about some money that was in the 401k. What I'm going to do with it? They're asking me like, hey, what are you going to do with it? And this is why I think that even lawyers that are going to try to say like, hey, they can't touch that money, they're going to be like, well, we informed them and they did, I think that's going to be the thing because you can't say that you weren't informed because you were informed. Okay. So it's good to, to read that. But let's kind of go through one of the main things. I'm going to read through this letter I did receive from one of the 401k portfolio managers. And I'm going to kind of explain to you guys how they're trying to break this down and they're actually going through with utilizing this. Like I told you guys, I'm going to come with receipts. So let's go ahead and read this together because it's a good chance that if they're sending me this crap, everyone else is getting it, and this is probably what's going to be done. This is going to actually take place, okay? So let me pull this up here. So it's only like 3 pages. It's not really that long, but I'm gonna go through all of it, okay? Just so you don't mention it. And it's gonna be kind of funny. Like think about this. I got this letter after I seen her videos and stuff like that and did my own research. And I like to wait for some kind of evidence physically in the world other than like videos, like things like that. So now I get this letter from my actual 401k, person. So it says, "Dear participant, this notice is to inform you of the designated investments alternative funds, basically the name of my funds, that'll be offered under the qualified retirement plan investment lineup. These changes are scheduled to take place July and August, subject to regulatory approval and other approvals. This bill passed in July, guys, remember, okay? So this notice is being provided to you to satisfy our regulatory requirement to notify you of these changes. You'll find a complete list of the changes below." And then this is funny. In addition, this notice is to inform you that the option you have a detailed statement mailed to you, an additional $1 per statement charge is no longer available, and this $1 fee is no longer applicable. So I guess they're trying to like soften the blows, saying that hey, you don't have to pay $1 to get your statements, which I wasn't getting in the first place. But that's basically what they're saying. Sorry guys, socks is trying to bother me. Um, but yeah, so and then it says where you'll get more information. You can find more additional information at the website, blah, blah, blah. A full list of the existing funds, including the applicable investments, such as expenses, performances, redemption fees, are available online at the website as well, too, under your investment options page. Next steps. If you would like your current investment in any of the affected funds to be invested into a new fund shown in the chart, no action is required on your part. You may also elect to transfer your assets among funds, including any of the affected funds at any time using our regulatory transfer portal procedures. If you have any questions or concerns about any changes in the plan's investment lineups, please feel free to contact me. Basically, what they are saying, guys, is that If you don't make any changes, we're going to change your funds to this other funds. What do you think that other fund is? Pretty sure it consists of private equity, right? And you're not going to know, right? Because the way they kind of label it. So it says here fund details, and they got to give you what the details is, but the details of the funds aren't even going to be details of the funds. It's all smoke and mirrors. So right now, it kind of shows you the following list of fund changes impact the investment lineup plan based on the information as of April 2025. It shows one fund name is called the Strategic Income Opportunity Fund. It's a fund merger. It's and basically it's an income fund. So right now it shows me the impact of expenses ratio. Let me try to hide this as much as possible. I don't know if I can, but anyways, it's kind of breaking it down right here, guys. And apparently that portfolio's has decreased about 18% or 0.18% um, since July 2025. And then they had this other fund that they're saying that it's going to switch to, which is called the American Funds Euro Pacific Growth Fund. Okay, it doesn't list the impact to expense ratio percentage, because again, it's going to change to that, and it's going to be effective. I think it says August 11th or whatever. So it's recently happened, which I got to go make adjustments to. And then it kind of talks about basically, please call if you have any questions about that part. So they're going to go ahead and do this, and I'm pretty sure if they're doing it, other freaking 401k or investment funds are doing it as well too with your retirement. All right. Now here's where reading the fine print comes into play. Remember how I was telling you, like, you don't know what's in these investments because it's just called the American Fund Europac Growth Fund. It's a fund that's supposed to help grow, right? Well, they have to actually tell you what kind of assets they're investing in. And before, a lot of these fund places weren't really investing in things like cryptocurrencies and stuff like that, which I think they're changing as well too, along with getting their bad debt from private equity. So right here it says the underlying fund inception will be target date 2065. I guess that's when they're expecting me to retire and start to use my funds. But anyways, portfolio highlights is what we want to look at. Pretty much from here on down. This is crazy. This fine print is crazy. And I'm going to tell you the key parts of how you know that they're putting this bad debt in there. All right, basically, to kind of sum it up, or to basically read it, because I said we're going to go through it. There's nothing on the back. Last page, guys, bear with me. Investment objective and policies. It seeks to get high total returns consistent with the asset mix, which is greater focus on income beyond the target date year of the 2070. Total returns, commonly understood as a combination of income and capital appreciation, includes interest, capital gains, dividends, distributions realized over a given period of time. The fund is designed for retirement plan participants who reach a retirement age at or near the year of 2070, who have a risk tolerance consistent with the fund's multi-asset strategies. They're basically saying this is why the purpose of the fund is existing. Now, why consider this fund? It has 3 bullet points. You look for the opportunity to remain in the same portfolio after the target date has been reached. You seek a one-step diversification exposure to domestic stocks, international stocks, fixed income securities, and stable value funds. And then another one says you have a considered risk tolerance that looks at your assets allocations and become more conservative over time, but still provide growth after your retirement. Cool beans. Investment process. The fund itself, talking about the new fund that they're switching me to, right? The fund takes a hybrid approach, meaning that it seeks to achieve objectives by investing in other passively and actively managed collective investment funds that are maintained by the company that represents a variety of major asset classes and investment styles. The fund invests using asset allocation strategies designed for investors expected to retire around that year. The trustee allocates assets among the underlying funds to the assets allocations and becomes increasingly conservative over time. They're just repeating the same crap over and over. To help reduce investments and risk volatility in retirement approaches in the end of post-retirement years, the assets will change over time accordingly to the predetermined glide path. The allocations reflected in the glide path are referred to as a target allocation because they are not reflective of decisions made by the trustee to produce an overweight or underweight position in any particular asset class. Under normal circumstances, any deviation from the target allocations is not expected to be greater than plus and minus 10%. The fund has a specific target date, but unlike any other underlying assets or investments. It will have no discretion to actively deviate from the targeted allocations shown in the offerings document. So that right there was just basically kind of describing to me what they're doing to the fund and why it exists. So bunch of mumbo jumbo, like I told you guys. This is where they finally give you the details. I'm letting you know. So potential risks include management, currency, derivatives, leverage, interest rates, real estate, REIT sector, credit and counterparty, prepayment, issue, issuer, risk of increased expenses, not FDIC insured, because remember your 401k is not FDIC insured, guys. Well, at least mine isn't. So extensions, restricted illiquid securities mergers and replacement of commodities underlying funds, foreign securities, target dates, portfolios, shareholder activity, emerging markets, loss of money, investment selections, debt market, focus, and market volatility and fixed income securities. Mainly what you want to gain from that is what I was been talking about. Debt market focus, private equity, the debt that they've been giving out, and that's really risky. Clearly, they're putting that in that portfolio. And it just says the normal stuff. You should consider investment adjusted risks and charges, exposures, all of the blah, 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 they say at the very bottom. Anyways, because I got that letter, guys, I know for a fact that they're putting this crap into your 401ks, and what's going to happen is they're going to be paying off that debt with your 401k, saying that it's a loss because the debt's not getting paid because it's crap debt. Point blank, period. No other way to put it. Okay?
You can't keep getting away with it! He can't keep getting away with it! He won't.
Now, if that wasn't enough, which again, I don't know why it wouldn't be enough, but had I not watched that video and stuff like that, I probably wouldn't even been paying that no attention. But let me tell you, if that is not enough, let's take a look at the bigger picture if you don't think that that's what's going to happen. And this again is why I'm assuming that it will. Think about everything. So one, I'm taking my experiences, not only going through videos and doing my own research and getting this paperwork and things like that. I know how the small business sector is, in particularly. I know that there's a lot of bad debt out there because why? A long time ago, when I used to work at a place, another financial institution, they give out loans, right? And these loans were ridiculously high interest, and people that were getting these loans were like desperate businesses, like your local mom and pop shops that couldn't keep up with the bills and make ends meet or pay their employees. They're using it for all types of different things. If they were successful at paying it back, they spent a lot of money to do so. I mean, these were high interest loans, guys. And crazy thing is, right? Obviously, this place that I worked at, there were some people, on average, you're doing like maybe $500,000, $700,000 if you're lucky. But I mean, there were people there that was giving out loans and doing like 1 to 2, 3 million a month and just giving out these high interest loans. Now imagine one person doing that, and this is a pretty big organization. It was like at least, it wasn't even, I wouldn't say one of them was huge. Some of them were huge, some of them were like mid-sized, but there's bigger ones that were us in our space that was bigger competitors. So it was not just us at this time. And this was probably 4 or 5, a lot. This was like, a long time ago when these things were coming out. And this was like, 4 or 5 at least small players that were now the industry itself. And I still kind of keep a track, like in the financial industry. Now that industry itself has gone bananas. There's a lot of different, companies in the space that do that. So I can imagine if it's been lasting this long, right? These loans are high interest and things are getting worse, right? People can't afford things. So how are they going to be able to make up these payments? So I know that bad debt is out there, and I know that these private equity firms are the ones who are getting it because I know the guys in this space that probably are investing in that, right? So there's that. There's one thing. Just from my own personal experience, prior long ago work experience, I know how this industry is. Again, me getting my own letters, telling me that they're gonna move my 401k without telling me they're gonna move my 401k. So all that and including the timeline makes sense, right? That's how I see that. Yeah, this is probably going to come through. And then, of course, you have the next big factor here we're on the brink of, which is AI. So now you have, not only is this bad debt here now with people working what they're working and small businesses handling what they can, now you got the implementation of AI. So you would think like, okay, AI will probably make small businesses more productive. However, at the same time, it is cutting out income from people who kind of power these small businesses and utilize these small businesses. Because I guarantee you, Jeff Bezos ain't going to the local taco shop. I don't think Elon Musk is running down the street to do laundry. Like these are the things that are going to take place, already taking place, but will get worse down the line. Less people are going to be working, which means that less business these small businesses get, which means more debt that's coming upon them. Okay, so think about that stuff. Like if you put all these things in perspective, not to mention the political changes in the climate. I'm not even going to get into that, but basically the overall economic market and outlook is not looking too good to the point where what they're trying to do is not going to happen because it is. Okay. Um, Everything is just falling in line. I mean, kudos to them. They playing the long game and they playing people like a fiddle. And that's just that's just gonna be the way cookie crumbles. I don't know how else to put that. But that's my 2 cents on it. The writing's on the wall. I mean, I don't know what else to tell you. But the problem is like, imagine if I never seen those videos. Imagine if I wouldn't think twice about this. If I didn't do my own research, I wouldn't think twice about it. But and again, this is just one sector of the problems that we're all facing, but it's an important sector because again, it's your retirement, it's your money, and we we've already been through this with 2008, guys. They're just playing the game behind the curtain now. Like, of course he's gonna, and then I'm telling Clint, like, of course he's going to let this happen, let that bill pass because imagine if another recession happened on his watch. I'm not even gonna talk about all the other stuff that's happened. Imagine if another recession happened on his watch. You can't risk that happening. So that tells me there, if you're passing this bill to let that go through, to let these guys tap into that 401k and bail them out, a public bailout is gonna look bad. Bail them out, secrecy behind closed doors, let people's 401ks take those hits, prevent the recession from happening. We're not gonna pay for it. Let the working class pay for it. That's what's happening. Point blank period. And we're letting them get away with it once again. But hey, who am I? Just another guy, right? So I'm gonna probably wrap this up here in a second, because I know a lot of you guys wanted to kind of get a good idea of what I'm doing. So, but this is pretty much it for you guys that are, again, like I said, that are watching this in the channel and things like that. I'm gonna go ahead and post my little game plan and what I plan on doing and what I think can be done, and let do your due diligence from there. We're going to talk about that here in a second. For the rest of you guys, hopefully you found this information important. What I would suggest, and I'll just give this tip to everybody, not just people who are subscribed and all that good stuff. I would suggest that if you do have a 401k, you're getting information about it, or you're getting letters about it, or even if you don't, call them up, take some time, say, hey, what's my stuff looking like? Like, get an update on it, guys, because especially if you have a significant amount to it, or those who are pension, speak to whoever's running your stuff, basically. Because with that change, you should ask them, hey, is there anything that's going to change? Just basically keep up to date with your stuff. Okay, that's what I suggest you do. That's one thing. That's one thing I'm going to do. But yeah, hope you guys liked this video. I hope this was informative as much as it could be. I do apologize if it's not. But again, check out Tiffany's videos. Those are really good. Comment, like, subscribe, all the above. I've got some more stuff coming out for you guys. I'm working on a lot of things, but we're going to keep it moving. The market's not going to change, no matter, regardless of what happens, guys. Again, we're in a market cycle. This is just how it works. Like I told you guys in the beginning, look at where we are now. For some of us who started, some of you guys who started, a while ago, if you're still here, which is great, a phenomenal kudos to you because you're lasting more than most. Look at how much the market has changed, and I think we're in that part to where this is going to be a change in the cycle of the market, unfortunately, but this is the nature of the game, unfortunately. So if you're trying to be a trader kind of thing, this is something you can expect. I'm not impressed when people tell me like, "Oh, I've been trading for 2, 3, 4, 5 years." You haven't even completed a market cycle yet, buddy. What are you bragging about? Okay, you're riding the wave. What's now? I think at this point we're gonna start to see that shift because you guys have already seen that even the markets have slowing down and change because the shift is happening right now, and that's just part of the nature of it. Okay, so again, me being in it as long as I can, I'm recognizing that, and it starts to it looks obvious when you've been in it long enough. This is why time in the market cannot be taught in the course. Like I don't care what nobody tells you, I don't care what magic pill they want to fill you. There's no strategy, not like that, that is going to take place of having time in the market and understanding all this stuff. Okay. So, guys, I want you to take this information and do what you will with it. It was for entertainment and educational purposes only, but I hope you enjoyed it. So, until next time, guys, you stay green. For the rest of you guys, we're going to go ahead and jump into the segment of what we're going to do here with what we know. All right.